All right, good afternoon, everybody. It's about 1:10 on Thursday, and we've had a really active day. A lot of interesting stuff being talked about. A lot of headlines. Got the storm. Got a lot of economic data. ECB, Bank of England, and we spoke with Tony Greer, Bryn Kelly earlier, and now we're joined by Tom McEntee, who is a former floor trader, equity specialist. He takes a look at options, equities, looks for really good risk-reward opportunities. He's been joining us often, about once a week, maybe more, talking about different things that he's trading, what he's seeing, different setups. And today he's going to be sharing his screen to really be able to show us how he analyzes things. So, Tom, you there?
Yes, I'm here.
Welcome. How's it going today?
Hey, thanks for having me. It's great. How you guys doing?
We're good. We're good. So we're excited. We got you up and running, so you can share your screen. You can kind of show us some different details about the way you analyze things.
Okay, so we'll start with this trade that I put on last week that I think we spoke of kind of briefly. We went over it, what the process and methodology might have been going into it. Now you can see this entire screen. I think it's all you need to know. What I want to look at, we talked about this Apple Qqq trade that I put it on last. Just trying to think. I just put it on this week. I said Monday or Tuesday. What did I start doing? Last week? Yeah, it was last week. I was sorry, last Monday or Tuesday. Right. So it was about 10 days ago. Okay. What I focused on, because obviously Apple had been screaming higher since the earnings. Since August 1, I believe the earnings came out. The stock at that point went from 190 to, I believe, 227, kind of where it is right now. So roughly, about a 19.5% move. While the Qs, we'll make it a 20% move, while the Qs were up about 6% at the same time, in the same time period. So by any metric or any metric you want to look at, it had stretched the relationship in a relationship that on a correlated basis, it has always been about 0.72. So 72 cents an apple, a dollar an apple, 72 cents in the Q and vice versa, in the Qs and vice versa. But now it had gotten to 20% in Apple equals 6% in the Qs. Well, yeah, that's one good thing where and I know that the Qs are made. Apple makes up roughly, I think it's about, don't quote me on this, but I'm in the ballpark, roughly 17% of the Qqq. Okay, so I look at that. I say, well, this one asset within the Qqq basket, if you will, is outperforming Qqq as a whole by a 3-to-1 margin, 20-6. So I said, well, maybe there's a bet there. Now, I'm kind of the opinion at that point in time that they're both overboard. But I'm big on, like when I want to sell things and stuff like that in short, I like to have some price history on my side. Maybe where it failed before, maybe where it bounced before gap or something like that. When these stocks and or indices get out to uncharted waters on the upside, I'm kind of, reticent to get in front of it. I'd rather have it like stabilize and give me what I might think is a fairly defined range. So I wasn't willing to call a top in Apple at 227, much to my chagrin. But so I said, the way I want to structure this is I've got two things going for me. I've got outperformance of Apple versus Qqq. It's outperforming at 3-to-1. I know on a correlated basis, it's roughly, here's the correlate. I'm going to click on my screen here. That's right there. This is from September 1 of last year to yesterday, and the correlation is 72%. It's a 72% correlation. So you know how closely these things move in 3/4 lockstep, so to speak. Okay, so now I look here. What has it been on a 20-day basis? Here I'm looking at daily returns over a 20-day basis, over a 20 trading day moving average basis. Now, I hope I don't lose you as I move the screen up.
No, we still see it. Yep.
So, okay, now down here, I'm looking at the rolling 20-day correlation. Now, you've seen, I guess it's been as high as 0.87 up in here, 0.88. This is back in, now I got the whole screen. There you go. Okay, so now, here it is, right before earnings, July 30. It was, correlating about a 0.834, as you can see, right? You can see, everyone can see that? And now in here, I guess 2 weeks ago, it got down about 0.23. As low, and I've extended this thing back. I went back 7 years, and for 7 years, it's been a 71% correlator, and the moving average on the rolling correlation has been about a point. So this is 0.22. This was as low as it had been in 7 years. I'll prove it to you. I'll go back to 2011. Okay. I'm sorry. It's a 2/3 correlator for the last 7 years. Okay. Now, this is the correlation on a rolling 20-day basis. Okay. It was 0.23 on August 30. That was the lowest it had been, I guess, since November of 2013 when Apple was trading, I think, around about it was a 7 for 1, maybe $35 rough. I'm sorry, $32, $33 split adjusted. So obviously these are kind of spots where I'm looking to take the other side. So the correlation had got down to what I thought was extremely stretched. Now, to put that on top, if you're constructing, I'm an options guy, so we're big on binomial trees and stuff like that. So I know I've got a stretch stock relative to QQQ. There's one part of the pairs trade. Second part of the pairs trade, I know the correlations. The correlation is way out of whack. Usually about 2/3. Now it's about 22%. 1 out of 3 there. Okay. Now I go. Let's look at volatility. Now I'm going to. This is the. I guess you can see that. Beautiful. This is 30-day implied volatility in Apple. That's the green. And underneath it in red is the 30-day implied volatility in QQQ. Okay. Now. The breakdown here is it's typically about on at the money stuff is typically about 5.6 to 6%. 5 points, we'll say 6%. Apple 6% over. Now, typically what happens is when that skew gets down, say it gets down to here. You see this what I'm pointing out on June 27, when Apple IV was 21 and the Qs were trading at 21. You see this thing I'm pointing at right here?
Yeah.
That's typical where guys who do dispersion trading, they'll be buying Apple volatility and selling QQQ volatility. Because what you want to do in dispersion trading, the theory behind that is they want to own the single components of an index or an ETF against the ETF itself. Because if you think about it, the volatility of the index as a basket should trade lower than the components themselves, right? Because you have the yin and the yang of one goes up. You got 100 stocks in an index. Not all of them are going in lockstep higher or lower, except on those extreme days. But by and large, there's a push and pull between the ups and the downs. So volatility would typically trend lower, trades lower in indices and or ETFs with baskets underneath them. So right in here, I would imagine, vol arb guys, dispersion guys would be buying Apple volatility to sell QQQ. They could do it even. You don't get that opportunity very, very often. Okay, but now look what's happened here since the earnings. Now, this is what really got me sold on the trade. Like I said, I was kind of reticent to call a top in the stock at, the 227 level, just because it hadn't been there before. And, every day you thought it was going to stop. It didn't. So I said, okay, well, I got two things going. What's the third thing? Now, look at Apple volatility. Here it is on August 24. You can see it's about 16, right? You see that below there? Apple IV 30, 15.9. Boom. Here it is. By September 7, last week, it's trading 24. 16 to 24 in roughly, 10 days. It had, jumped up, what's that, 50% roughly, right? Now, look at QQQ vol. It had gone up, but not by nearly enough. So what I'm saying, and now what you had here was also, so now Apple vol, typically I said traded about 6 over. Here you see it's trading roughly 8.5 over. At the apex, say on 9/10 Monday. Okay, I did this thing last week, a little early. But as they say, I'd rather be a little early than a little late. Okay, so we know that. So I know that the volatility in Apple was trading at a level that historically is roughly 33% higher than the normal historical relationship with the QQQ 30-day volatility. So I'm just trying to put binomials together where I think I've got an edge, where I think if I can stack a 3 out of 5 shot of winning and a 3 out of 5 shot of winning and a 3 out of 5 shot of winning, well, it's only the only way I'm going to lose on all three is about that's about 8 out of 120, 8 out of 125, or about 6.5%. So I got a pretty good shot. If I win one, I'm going to do okay. Okay, so now I look back. Now I want to go out further. So I'll say, hey, let's look at skew here. I want to look at Apple skew by delta. Okay, so now Apple skew by delta. Okay. Now, right here, This is today. Okay, this is what I'm pointing at. This is the broken red line. Okay, that's a 25 delta call in Apple. Now, we spoke about this last week. I mean, the 25 delta put and call are typically where variance swaps transact. And it's kind of a basis for the way a lot of these big, where these bulge bracket firms will make markets and options. Okay, so the 25 delta call here was trading at 21.6, as you can see, right? Apple. The 25 delta call today is 21.6. Yesterday was 22, so it's come in a little bit. Now the 52-week average is roughly 21. Now, if I can, this thing won't let me go back any further, but as of like last week, this thing was trading 23.24. Now, interestingly enough, which you very rarely see. Now you notice this is the 52. Let's focus on this here. The 52-week average of an Apple 25 delta call, 30 days, is roughly 21 volatility. Okay? Now the Apple at the money, 50 delta, you see this 50 down here is the delta. 50 delta call is typically 21.6. So this differential between the at the money 50 delta call option and the 25 delta call option, 21.6 to 21. Now you got to realize, I would look at median here and not the average, because the average gets skewed by some dislocation in terms of earnings, stuff like that. So that throws the average all out. The median would be a lot higher. So anyway, for our purposes, that's all I want to show you is the absolute relationship. So the 50 delta call is trading 21.6. 25 delta call on a 52-week average basis is roughly 21. Oh, okay. So what I have here is, wow, it's trading six. It's roughly 6 clicks, a half a click over. Typically, the 50 delta with 25 delta.
Hey,
but last week and this week, you've got it trading at parity. It was actually trading higher. The lottery calls had traded higher than the at the money calls. The out of the money calls had traded higher because I think two things. Now, this is just back of the envelope kind of thinking, is that I think the stock had risen so hard and so fast and blown out so many ratio riders that everyone had to scramble to buy calls because the deltas became real. Because I mean, the average guy, you saw what happened here. Now, this is really cool to look at, because I think this will help everyone when they try to when they look, see how options behave, why they do, or why a stock behaves, why it does, or why the volatility. Now look here. Here's earnings. Okay, this is before earnings, right? July 30th. Obviously, the spike because of earnings are coming out. We're going to get the straddle's roughly 4%, something like that. 8, 9 at the time, an $8 straddle. Okay, here it is. Earnings come out. Now here we are on August 6th. Everyone can see that. August 6th, roughly about 4 or 5 days after earnings. Vol's down at 16. And now I can show you where the stock is. The stock is this chart here. So now the stock is roughly 207, but then as the stock begins its meteoric rise up to here, I mean, guys who come in and his volatility is 17, it dips down as the stock is just so relentless. Another weekend, that final push higher towards 229. What happens is, guys, say you buy the stock at 190. Say you buy it at 197. You bought it at 200 the day of earnings. Okay, traded 190 yesterday. Earnings came out, opened 197. It's trading 200. I love the story. I'm getting long. I'm buying stock. I'm going to sell some calls against it. Well, I'm selling because you know what? I think volatility is going to come back into like the 14, 15 level where it was in here. I think, the news is that I'll sell 16, 17 volatility. So what these guys do is, anybody who has been in option crowds or pits in the past has seen this kind of behavior before. And, I'm not saying they're always wrong, but when they are wrong, they're wrong big. Because they're ratio riding the stock. So say they buy the call at 200 and they sell it, at 10% out of the money call. I'll sell a 220 call out 3 months or something like that. So they go out to November or September. I'm sorry, it's August. They go out to October or November and sell the 220 call. Well, it's a great sale with the stock at 200. As long as it's, so they sell it. Say it's a 5x2. I'm just taking a shot that delta's around 40. So say they sell 5 calls, buy 200 shares of stock. It's a great strategy if the stock just drifts, works its way higher, grinds higher. But when you get this, I mean, it's a parabolic move, right? I mean, you get 20% in the highest you got 20% in the highest capitalized company in the United States.
Exactly. That's what Larry's been saying as well. I mean, it's moving billions and billions and billions in market cap each day.
Right.
Right now I think we're just trading 215, 216. It might have been yesterday or 2 days ago, and here we are, 226.
Right. I mean, so what I think happened, and I saw a lot of open interest. I don't really follow this stuff. I don't know what I really don't want to know what other people are doing, because I have a hard enough time to figure out what I want to do. But I saw a lot of open interest on the 230 line when the stock was pressing right in here, 220, 227, somewhere in there. So I think what happens is, like, all of a sudden people start buying these, because the ratio riders are bagged. You're short the 220 calls, 5 against 200 in the stock. Well, that's great. The stock's trading 220, you made $20. But these calls are starting to explode. Now they have a real delta. The 220 calls with the stock at 228 are about a 62 delta. Now you're short. Now you're short. Okay, every one time you do that, you're short 1,000 deltas, short 100 deltas. Now you got to go and scramble, or you can wait, whatever. But I think people scramble and just reach for anything, because when your feet are put to the fire, you reach for anything to take it off your sheets or to get some type of protection on. So what I think happened there is, in lieu of buying stock up at these, I guess, for lack of a better word, nosebleed levels, people run and buy calls. I'll buy the cheapest thing on the board. Nothing's cheap on a relative basis, but it's cheap on a notional basis. This doesn't always work. So they run and buy all these upside calls. Well, to me, that was the third part of my binomial equation here. I can sell out of the money calls that historically traded a slight skew. The Apple, there's a slight skew in Apple from, like, as we showed before, from top left to lower right. But now it's trading, more like more with a smile, more with a commodity type look. So I'm able to sell upside calls in Apple, taking in skew, while buying upside calls in QQQ, where I know there's a relationship. There's a hard relationship there. Buying those calls with spice, and essentially selling skew. They're trading at the historical norms. I'll show you what the QQQ did. So we said the Apple 40 delta call was the Apple 25 delta call was 21.6. Okay, I want to do it by delta. Here, I'm sorry. Bear with me 1 sec. The pressure's on when you're doing it in front of a live audience. Nothing like a live show.
It's good. I like it.
All right, so here, Qqq average on a 52-week basis is 12.9. Well, if I went back, I can't. I'm sure I can, but I don't know how to do it. But I think I was paying roughly about 12.9. I wasn't paying any premium to buy QQQ upside. So I'm buying QQQ upside at 12.9. I was selling Apple upside at one time 23. That relationship typically tracks at about 4.5 to 5 clicks. Okay, if Apple's trading 18, Q's trading 13.5, or vice versa, or something like that, somewhere in that ballpark. I'm sure it has, but I've never seen it trade at 10 or 11 clicks. So I had so much room, and obviously hindsight's 2020. And you can call me a jackass because it was a winning trade, but that's fine. but yeah, hey, look, I'm wrong plenty of time too. But I had 3 things going for me: outperformance, correlation, and I had upside skew. I'm selling a relationship that's typically 5 clicks. I'm selling it at 10 clicks. So that gives me. I talked about this every time I've been on the show. I've been on the webinar. The concept of room. I have a lot of room here. That allows me to leg things. So I did a few things. I did a few of these things. I do it. So I did it. I wanted to balance it out by dollars, by price weighted and Vega weighted, volatility weighted, right? And I think there was a question in the chat yesterday by KCM, and it was a great thing. I think the 3 of us have been speaking about this before. Yeah, position sizing. So, like I said, I'm kind of agnostic on the relationship. I'm kind of agnostic on direction here in terms of QQQ and Apple. I just think QQQ, the price should mean revert. The volatility relationship should mean revert. That's all I'm looking for. I've got history on my side. I got history on my side in 2 big ways right there. Does it mean it's gonna happen in the next week or 2? Probably. I have no idea. But I want to have those edges going for me. So what I wound up doing is, QQQ is $180, and we'll just keep it simple. $180. Say the volatility was 13. So I would take 180 times 13, right? I get it. What is that? About 23.4, and then as a 25 delta option, we'll say 6. Okay. Apple at the time was say 2. It was 230. typically about a 18 delta thing. That's an 18 volatility thing. So that's 360. That's 414. 25 delta there is about 10. So my ratio was about 10. So my ratio there was 1.8 to 1. So I had to buy 9 Qqq calls, and sell 5 Apple calls. So I wound up doing it. So I sold a 25 delta Apple call. I think at the time they were the 235s. No, I'm sorry. They were the September 28, 237 halves and 240s. That's how it pumped these things.
Wow.
With the stock right here. Now compare and contrast what was going on that day to what's going on today in Apple. Like I sold a 238 and 3/4 calls. What I did was look at the wrong thing. I sold these here. I sold one of the 237 halves and one of the 240s to create a hybrid 238.75. You follow that?
Yeah.
So I sold a blend of 5 of those. Say I sell 10 of those, and I buy 18 Q. I think the Q were the 190s. I paid like 92 and 93 cents 9 times and sold that thing. I think I took in. My first tranche was at about 240. Then I sold it at $4. So that was like for every 9 by 5. Okay, so if you want to divide that by 5 and get a 1 by 8 by 1, I'm doing it for like 48 cents, and then I did it for 80 cents. So I had so much room there. So on Monday or Tuesday this week, and I had some put spreads in Apple that I put on about a week or 2 ago. And I think on Friday afternoon, the stock traded down to right around 220 after the market closed. I knew I could buy it, somewhere in there. I knew it was not like a 217 number was big for me. I don't know why. Anyway, I bought stock at 218.86, I guess, on Monday morning. And I think I bid below it, 213 something. Didn't get it, obviously. But the relationship, those 237s and 240s had come into that thing was like, I think it was under I'm just trying to think, 19. I think I sold those at $1. I think I might have paid a total of $2 for the combo. And this is the way I look at things. And then this is also, I think this is good for a lot of people out there. I mean, I bought back, I think these calls, the 237 and a halves and the 240s were roughly, I'm going to say 80 cents and 40 cents or something like that on Monday morning. Don't quote me on it, but I think I'm in the ballpark. So, and normally I'd like to, I don't mind letting the 80 cents and 40 cents run, but that's in a $40 stock or a $50 stock, but you got to get your mind around the fact that it's this is a $220 stock. So it's a different animal altogether. So I made the decision. There was still a vol play to be had rolling out to October. So I covered all those SEP 28s. I sold out my Q SEP 28s. I made, I did fairly well there, and then I rolled out to October. So essentially, what I have on here now is I wanted, this feeds in a room, and I think Larry can speak about this, or a lot of the guys can speak about this, because I had a lot of edge. I think, and like I said, you want to call me a jackass for touting, for I don't mean to be slapping myself on the back, but I'm just saying I had a lot of edge here, and that's the only reason. When you get this kind of edge, and I saw the type of disparity involved, the vol was still there. So you know what? And I had a winner. So I kind of, I now the stock had given me some type of range. Okay, now it had given me, I think the 229.12 was a high. I'm not sure. I don't have a chart in front of me.
Yeah, it was a big one. I remember you posted it in the chat. You were kind of you even called up, wanted to give Larry the heads up. He was actually out of the office at that moment, but you said this is a really high conviction, really makes sense trade.
Yeah. Okay. So now essentially what I have on is boom, right here. I'm short these. I wound up so now what I can do is, since I have room, I know I'm taking in 10 clicks. Now I think I came into like 9 clicks, 10 clicks, but I know it's twice what it should be, or twice what it historically is. So I said, you know what, fine, I'll still play it. I'll use that 220, the 227 to 229 spot in the stock as some type of yard marker where I can sell stuff against it. But I'll stay true to the original tenets of the trade, and I'll just sell options. So I wound up selling. I think I sold these 232 halves right here. They're about $2.70. I sold them. I mean, you can see in the chat. It was 2 days ago. $2 and I think they were $2.53 or something like that. And the stock was 223.
Well, it's also interesting. I'm looking. The VIX right now is trading 1247. You know, it's down 5% on the day. We're trading up. We traded almost 15 yesterday or Tuesday. So you know, that's
right. No. So I think this Apple thing is a high conviction trade, and I still have it on. And now I'm on QQQ 187.5 against the 32.5, 9x5 base. But I had so much room. I got lucky because I legged it on Tuesday. Sold it 253. I bought Qs yesterday at I bought the 86s at 90. I think 89 cents at 91 cents, something like that.
I only have like 5 more minutes, but I was thinking,
go ahead.
Are there any other?
Yes, I want to show you another one. I think, Tesla. That's a favorite.
Oh, okay.
Everyone loves Tesla.
Volatility sky high.
All right, here's a loser for me. All right, just to say that, believe it or not, I do have losers.
That's
right?
good as well.
Like
taking us through the losers.
Just unlike the guys on television, I do lose.
Right.
Here, I sold stock at like 282.90 on Monday, and Tuesday it traded down at like the 274 level. But I gotten lucky with a scalp like on Thursday or Friday. Blah blah blah. And what I noticed was this: I still think, or I thought, and I still think that the stock can trade down at like the 244 level. So to that end, I say, look, obviously you can see this. This is a big thing for me here. This 25 delta put minus the 25 delta call. Okay, this to me is a great sentiment gauge where people are kind of putting their money. So right now, the average here. I'll give you the. Show me the average. Okay. The average between these two is typically the call would trade, the put would trade 48, the call would trade 42. So it'd be about a six volatility point spread between a 25 delta put, 25 delta call. But now you see this since Musk started tweeting. I guess he wants as many followers as Trump. This thing is blown out. I mean, it got as high as 20. It's trading 13.5. So what I'm looking to do is here, I think, in order to finance that bet down at 244, look, it could happen tomorrow. I don't know. It could also trade 320. I'm already wrong for about $9. I want to say what I want to do is something like this. I use that 25. I want to use that 25 delta put call thing to my favor. I want to take in more edge. I think the stock right in here at the 280. I know it's traded. It's 291, but at the 287 level, I think it's kind of important resistance. It might become important support, much to my chagrin. But I'm looking to do something like this. I was kind of keying, like if I was fortunate enough to get the stock go down to 270, okay. I was going to look to buy like a 25. Go out to October 5th, and maybe buy like the 320 calls. We'll say $6. Do you see those?
Yep.
Okay. And I'm going to sell a 25 delta put, which would be the two. What I want to do is I want to sell this. I want to buy this 320 call, pay $6. That's a 20 here. 322 and a half. Pay $5.20 on the 322 and a half. And I want to do this. I'll sell the. I want to sell it the 250s, the 250 puts at around 550. Now I'm looking for the stock to go down $20. I want to do this thing for a credit. Okay, so this is something I'm looking at. I look at this. I'll buy this 25 delta call. We'll keep it simple. Right here, I'd be looking to do this against my short stock. Buy the 320 calls at $6. These are October 5 expiration. I'm waiting on this. I'm not doing it here just for an illustration. Buy the 320 calls at $6 and sell like these puts here. Right now, 25s against 25s, apples to apples. Sell the 265 puts at 8 and change, 8 and a quarter.
When are these expiring?
October 5 expiration. So 3 weeks from tomorrow, is that right? Yeah, 3 weeks from tomorrow. So I'm taking in $2. I got a $2 credit. So say I'm short the stock at 283, wherever the hell I should. Yeah, short it at 283, plus $2. I'm going to participate all the way down to 265. So essentially, it's a great way. Now I'm getting, the way I look at it is, look, I don't know. The guys who are buying puts, I'm sure they're a hell of a lot smarter than I am. That's okay. I just want to take that. But there's edge there. And I like to think that I'm savvy enough to take advantage of that edge. So if I could sell that for $2, I got a gain. I was looking to do it on Monday. The skew was more pronounced. I was looking to buy like the 290, 230 for a $3 credit. But that obviously didn't come to fruition. Those are the kind of things I'm looking for. Take advantage of the skew.
Where are those 320 calls trading?
These are October 5.
Yeah.
What do you look at? I think about $6. About right.
Yeah. And then the let's call it $50 lower. I guess it's not 50. It would be like more like 30. Yeah. So it's
30.
roughly right. So it's like $12.
Right. So what I'm doing, so I'm taking into credit, right? So I sell a stock at 282, we go down to 265. I make 17 on the stock and $2 on the spread because I'm getting paid to sell those puts. Look, like I said, the guy's probably right. I don't know, but I don't care. If I can take in the edge, I'm fine. So I just want that. So that is. I mean, I did something in Tesla with the stock at 366 where I sold puts for 325s against 400 calls. I mean, even with the stock down at 310, I made money because the skew was that pronounced. You're able to take in that much edge, and it's still there, and it's not as pronounced as it was then. It's 13.5. But look, I mean, you got to be, if you're watching the stock, you got to be aware enough to figure that if the stock does trade down towards 270, now it's kind of been somnambulant here the last 2 days, but if the stock does trade down towards 270 in the next day or two, well, the volatility of the puts is going to get jacked as it has on any type of down.
Yeah.
So that's where I'll look. That's where I'll look to put something on. But I think you keep an eye on that. You want to finance a short bet. What you're doing there is if you did it one up. If you did that one up, say you did it right here at 291, you sell the 260. You take in $2 for that. For that spread, the 325, 265, whatever the hell it is. You do it one up. You take in $2. You do it one up. I mean, it's a real good spread. Essentially, you're selling a 265, 320 call spread at like what's that? It's 28, $30. That's a great do.
Yeah, it's
a great do. You're selling that 55 point spread at $30. So that's a real good do. You're kind of synthetically selling it right there. That's one thing.
That's really interesting, and that's really you've been coming on with us for a month or two now, talking weekly, going through your trades, the options, the risk reward, and it's really good to be able to actually see this and show it very clearly exactly the way you're looking at skew, the puts, the calls, and different variants between volatility and different stocks, things of that nature. So very helpful.
Hey, great. I'm glad I could be of service. I enjoyed being on anytime.
Yeah, well, definitely. We'll do it again next week. Tom McEntee, Equity Trader. Thanks for your insight.
Hey, thanks for having me, guys.
All right.